Hi, everybody. Natalie Beckett back with Trade Monster. Thanks for looking through those disclosures for us. We're going to get started with Chuck now. We just want to let you know we're having a little bit of a pipeline issue with WebEx, so we are unable to ask questions during Chuck's webinar. However, if you do have questions, you can feel free to put them in the question and answer or chat box. We'll try to get to as many as we possibly can. The webinar is going to start now, Chuck. We're going to go ahead and mute ourselves. I'm going to give you the reins, and then you can begin. Chuck, I'm passing the reins over right now.
Chuck, did we send the presentation to the wrong one? Are you there? Chuck, we see the presentation coming up, but we don't hear you. Chuck, we're still having an issue. We can't hear you. We can see the screen, REIT and MLP Income Strategies, which you need to get up bigger, but nonetheless, we still can't hear you. Folks, we apologize for this. We're having just a little bit of a communication pipeline issue with Chuck and our servers here, so we'll try and rectify this as quickly as possible and get started. Thanks. All right, Chuck, now we hear you, but we don't see anything on the screen.
Oh, okay, yeah, let me pull it up here.
Now we got you. If you can enlarge it under slideshow, we'd be good to go. And then we're gonna be quiet so we don't have reverb. Okay.
Okay, and you can hear me okay?
We can. Looks like you worked it out. At least we can get on with the webinar. Thanks, Chuck.
Okay, you're welcome, Tom. Okay, good afternoon, everybody. Sorry for the technical problems. That's the first time that's happened in my presentation, so we'll have to look into that. But today I wanted to talk about the Real Estate Investment Trust and MLP Income Strategies. And these are strategies I've been trading for a long time, and there's big advantages to these strategies, whether you're trading the stock itself or if you're trading the call option or the covered call. And I'll show you why over the past 40 years that these real estate investment trusts have outperformed every market sector over the past 40 years. And there's a reason for that. And this is a great strategy if you want to develop an income stream, which I've done over the years. And I'll show you how to compound those results too. So this is a great low-risk strategy if you want to develop an income stream. So we're going to look at the MLP, REIT income strategies, and we'll look also at the option strategies, and then I'll try to pull up the questions at the end there and answer as many questions as I can. So the income strategy is very simple. We want to invest in companies that have a history of increasing their dividend. And these REITs and MLPs have a long history of increasing their dividend, very solid investments. And then we're going to look at compounding the results by reinvesting the dividends in additional shares of stock. So there's no complicated math or formulas to this simple income strategy, and it's a great way to allocate that portion of your portfolio that you want to have in less volatile investments and develop a steady income. And we're going to look at master limited partnerships and real estate investment trusts. So the basic concept behind dividend growth is that dividend growth is a reliable forecaster of future earnings growth and financial health. So if an MLP or REIT is increasing their dividend, that's a really good sign. And corporate directors, they're only going to raise those dividends if they believe that future earnings can sustain payout. So if you see a steadily increasing dividend, that means that the corporate directors are comfortable with the company income. Otherwise, they would not be raising those dividends. So that's a sign that the company is healthy and prospering and growing. Now let's take a look at the real estate investment trusts first. And an REIT is a special type of corporation, and it does not have to pay federal income tax if the REIT distributes at least 90% of its income to its shareholders. So as a result, these REITs, they pay much higher dividends than other dividend-paying stocks because they pay no tax. And there's two major categories of real estate investment trusts. There's equity REITs that own the physical properties, such as retail shopping centers or apartment buildings or medical facilities. And then the second type is mortgage real estate investment trust, and they invest in mortgages. So the REIT strategy is very simple. We just want to buy REITs that have a history of raising their dividends and then reinvest those dividends in additional shares. And if you do that, that allows you to compound your returns. And I'll show you examples of how I do that. I just automatically reinvest the dividends through a dividend reinvestment program, and it's done automatically by my broker. And then I accumulate more shares each quarter when the dividend is paid out. So we're going to look at a sampling of real estate investment trusts, and what I did is I compared the return of these real estate investment trusts to the S&P 500 index. And as you know, over the last year or two, the S&P 500 index has been making a series of new all-time highs, and it's been in a strong bull market the last year or two. Despite that, the S&P 500 index has only produced a 47% return as of this week over the past 15 years. And in contrast to that, these real estate investment trusts, and this sampling that we're going to look at different types of real estate investment trusts, that's produced over that same 15-year period has produced a 1,169% return, outperforming the S&P 500 more than 20 to 1. Here's the first one. This is Realty Income, and I've owned this real estate investment trust for a long time, and over the last 15 years, it's had a 965% return compared to the S&P 500 index. So here's a graph of that 965% return versus 47% for the S&P 500. Here's Avalon Bay. That's a residential real estate investment trust. That's had an 838% return over the past 15 years versus 47% for the S&P. Here's another one. This is Tanger Factory Outlet, and this REIT owns factory outlet stores. And over the last 15 years, it's had a 1,300% return versus 47% for the S&P 500 index. Here's another one, Simon Properties, 1,500% return over the last 15 years. And here's one more. This is Public Storage. They own the public storage units throughout the U.S., and they've had a 1,200% return versus 47% for the S&P 500. So you can see that these real estate investment trusts have way outperformed the S&P over the last 15 years, and I did historical testing over the past 40 years, and these real estate investment trusts have outperformed all other market sectors. So the fact that they don't pay federal income tax gives them a huge advantage over other dividend-paying stocks. So, and it's been a very consistent performance too, and I'll show you price graphs during the 2001-2002 bear market, where these real estate investment trusts actually were profitable during that severe bear market when the S&P lost over 50% of its value. So these have great bear market resilience, these real estate investment trusts, because that dividend that they pay creates a floor underneath the stock price, and that helps dampen out the volatility of these real estate investment trusts. So they have lower volatility than the stock market in general. And they have less severe sell-offs during bear markets, and they're more bear market resistant. And also, these real estate investment trusts are ideal for call option purchases because of their lower volatility and because of their strong return over the past 40 years. And I'll show you just a couple examples. Here's the top price chart is the daily price chart of Intel, and you can see during that 2001-2002 bear market, it lost 80% of its value, and then during the 2008 bear market, it lost another 60 or 70%. And The bottom graph, this is the price graph of realty income, and this is paying over a 5% dividend now. And I've been reinvesting those dividends every quarter, so I've been building up my position in this realty income. I've owned it for a long time, symbol O. And you can see during that 2001, 2002 bear market right here, this real estate investment trust actually rallied 50% versus a 50% decline during that bear market for the S&P 500 index. And you can just see by the price movement over the last 15 years, a lot less volatility than Intel, a much stronger price uptrend, and during the two bear markets, while it actually was profitable during the 2001 bear market, less of a downdraft here during the 2008 bear market. And that was a pretty severe bear market as well, as you can well remember. So a good long-term investment for that portion of your portfolio that you want to generate income. Here's another example. This is a price graph of Goldman Sachs and versus Tanger Factory Outlet. So again, you can see a much stronger uptrend for Tanger and less severe sell-off during the bear markets. Let's look at covered call investing too with these real estate investment trusts. I sell monthly covered calls with the real estate investment trust, and here's a recent example. I added to my realty income REIT position, and I bought 800 shares at $45.97. This was last month, and then a few trading days later, I sold 8 of the 45 calls at $2.50. So I added to my position. I've owned this stock for many years. Went ahead and added to my position, bought 800 shares, $45.97, sold the 45 calls at $2.50. And this particular trade has about a 3-week length. And let's take a look at the profit potential of this trade. We can see that selling the 45 call, if realty income closes at or above the strike price, this 45 strike price, I sold the 45 call at $2.50. I'll have a $153 profit for each 100 shares, and a percent return of 3.5% for this particular trade. And if I was able to do that on a regular monthly basis, this type of monthly covered call has a annualized return potential of around 60%. So this is a great way to participate in the performance of these real estate investment trusts, and at the same time collect some income. So writing monthly income covered calls on this on these REITs is a very good strategy I've been doing for many years. Let's look at reinvesting the dividends. What I do is I reinvest my cash dividend that I receive every quarter in additional shares of stock. So that enables me to compound my returns. Here's an example. This is for American Capital. This is one of the mortgage REITs. And here's, I took a snapshot. I received a $5,600 dividend. So I went ahead and I was able to purchase another 191 shares. So if I simply hold my position in AGNC, I'll collect over $20,000 in dividends every year, and then I'll reinvest those dividends in additional shares, and I can accumulate another 750 shares or so a year, and that will allow me to compound my returns. Here's an example. I just took this snapshot. These are dividends I received in my brokerage account. They total about $84,000 in cash dividends, and most of these have been reinvested in additional shares of stock. And this is a snapshot. My advisory service has an MLP and REIT portfolio, and this lists the current open trade profits. It lists our entry price, the number of shares we own, the last price, the profit, and then the percent return. And we currently have $249,000 in open trade profits, average return of 311%. So this is the type of return that you normally see trading options, but this is just trading the stocks themselves, the MLPs and the REITs, and reinvesting the dividends. So that's a pretty good return for such a low-risk portfolio. And now let's talk about master limited partnerships. And MLPs are similar to the real estate investment trusts in that they don't pay any federal income tax. So once again, that gives the MLPs a huge advantage over other stock investments, other stocks that pay dividends, because they pay no federal income tax and they distribute their income to the shareholders. And there's an additional tax advantage to the MLPs, and they pay dividends which are called distributions. And the IRS generally considers 80 to 90% of these distributions as a return of capital, which means investors can defer taxes on these dividends for many years and then not pay until they sell their unit. So this is a tax-deferred strategy where when you receive a distribution, 80 to 90% of that distribution is not taxed. So due to these favorable tax treatments, these MLPs, master limited partnerships, have attracted a variety of companies in different industries, oil and gas exploration, coal mining, energy pipelines, timber, fertilizers, and real estate. And these MLP, master limited partnerships, they're able to sidestep the IRS and just pass on their earnings directly to the investors. And our MLP strategy is very simple. We want to buy MLPs that have a history of raising their dividends, and then we want to reinvest those dividends in additional shares to compound the returns. And once again, the dividend growth rate is a very reliable forecaster of future earnings growth and financial health of a company because those corporate directors, they're only going to raise that dividend if they know that the future earnings can sustain that increased dividend. So that's a good sign that the company is healthy when they're increasing the dividends. And let's look at a sample of master limited partnerships over the last 15 years, their return compared to the S&P 500 index. And this was as of this week. And the sample I looked at had an average return of 1,865% versus 47% for the S&P. So that's quite a bit of outperformance for these MLPs versus the S&P 500 index. Here's the first one. This is Plains Pipelines Limited Partnership. And most of the MLPs I invest in are the pipeline and storage MLPs. And they merely transport energy and store it. They're not involved in the exploration, and they're not tied to the price of oil as much as oil exploration companies. because these pipelines simply transport the energy and store it. So they're just basically toll roads to move this energy around and store it. So as a result, they're not as dependent on the price of oil. They don't fluctuate as much as oil exploration companies do on the price of oil. And this first one I'm looking at is Plains Pipelines. Owned this one for a long time. The 15-year return for Plains was 1,400% versus 47% for the S&P. This is One OK Partners, and it's had a 950% return over the last 15 years. Kinder Morgan, this is one of the bigger ones, and this has had a 1,140% over the last 15 years. And they recently announced that they're going to be increasing their dividends 10% over the next 5 years. So there's a lot of visibility to this company when a CEO says that we're going to increase our dividend 10% over the next 5 years. That means that he feels that the income stream will be there over the next 5 years in order to support that dividend increase. This is Energy Transfer Limited Partnership, 1,900% return versus 47%. And that's the last one we're going to look at as far as the MLPs and their outperformance compared to the S&P 500 index. And again, we want to reinvest the cash dividends in additional shares of stock that enable us to compound our returns. Now, this is an interesting snapshot. I took this yesterday, and this is from Yahoo Finance. And if you go into the historical prices, they have historical prices for stocks. And what they do is they adjust the historical price for dividends that are received, and they have what they call an adjusted close on this right-hand column. And you can see that over the years, Kinder Morgan, if you adjust it for dividends, would only cost $1.24 after you adjust for the dividends, and it was trading yesterday at 98.30. So you can see that that's a pretty good return over the years. After you account for the dividends, it only costs $1.24 per share, and that works out to a 7,900% return for Kinder Morgan. So I thought that was pretty interesting, and it shows you the power of these dividends that only cost $1.24 and is now trading at 98.30. So that's a pretty good return. And I took a look at the historical performance of these MLPs. They've only been around for about 20 years because that was a special law that was passed by Congress to create these MLPs, so they don't have as long a history as the real estate investment trust, but they've been around for about 20 years, and they have outperformed all other market sectors. And just like the real estate investment trust, they have lower volatility than the stock market in general, and they have less severe sell-offs and more bear market resistance. So the MLPs are also ideal for option investing. And when we invest in options, we use what I call my high accuracy option trading strategy that I've presented in previous webinars. And we have certain rules when you want to take an option trade. We have what we call the 1% rule for selecting the option strike price. And this is a big part of successful option investing, is which option price do you buy. So we actually have a rule for that, the 1% rule. And if you follow the 1% rule and you buy an option in a master limited partnership, the stock only has to go up 1%, and that option will break even and start making money. So we have the 1% rule for selecting the option strike price. We have the 30% walk away rule, and we will simply exit an option trade if we have a 30% loss from our purchase price. And what this does is options are highly leveraged, and this prevents us from taking a very severe hit, a 50 to 100% loss, and we can come back and trade again if we take a 30% loss versus 100% loss, which is possible with options. And then we also have a 30% rule for protecting profits, and what we do is if we have a 30% profit in an option trade, then we'll go ahead and initiate either a market neutral spread or an option debit spread to protect the profits of the option. So I covered that in previous webinars, our high accuracy option trading strategy. And let's look at a couple examples of these MLPs over the last 15 years versus stocks. This top price chart here is for Weatherford, which is an oil service company, and you can see that this has been very volatile. If you're trying to buy options in this oil service company, if your timing was off just a little bit, you obviously would have been stopped out. So very volatile. Hard to predict the trend on this type of stock, this oil service stock, and this is more tied to the price of oil fluctuating. So we contrast that with the bottom price chart is for enterprise products. Again, that's a pipeline master limited partnership, and we can see that Weatherford had an 80% decline during that 2008 bear market, and the enterprise products had a much less decline during that period. And during the 2001 bear market, the enterprise products actually made money during that other severe bear market in 2001, 2002. So this just contrasts an oil service company and development company compared to a company that just merely transports energy and stores it. So I'd much rather be buying call options on enterprise products than on Weatherford. Here's another example. This is the top price charts for BP, Amoco, and very volatile price moves compared to Plains All American Pipeline Company, which actually had a profit during the 2001-2002 bear market, a less severe sell-off during the 2008 bear market, and it'd be much better to trade call options on the Plains All American pipeline, obviously, than BP Amoco. Another choice that you have for these master limited partnerships are exchange traded funds, and there's currently, I think there's 7 or 8 different ETFs now that trade a basket of these master limited partnerships. So that's an easy way to participate in the sector by just holding one stock. And I actually own the MLP Infrastructure Index, symbol MLPL. And when I took this snapshot, I had about a $30,000 open trade profit in MLPL. And here's a snapshot of my brokerage transaction history. And I have this MLPL ETF. I have that set up on a dividend reinvestment plan. So I received a $4,700 dividend, or they call it a distribution for MLPs. So I received this $4,700 distribution from my position, and then I automatically invested that with the Dividend Reinvestment program, and I was able to get another 114 shares of MLP. So that's how I compound my returns. I buy additional shares after I receive a distribution. And once again, here's the snapshot of the advisory service, the MLP and real estate investment trust portfolio, and this lists the various MLPs and REITs that we own, our entry price, the quantity, last price, and then our profit and percent profit. And currently have $249,000 of open trade profits, average return of 311%. So those are the kind of returns you would expect trading options, but that just shows you the powerful uptrend in price performance and dividend yield of these MLPs and real estate investment trusts. And again, here's another snapshot of recent dividends I took, or I received about $84,000 in dividends. These are in my retirement account. So that concludes my presentation. And if you'd like more information on the various strategies, you can log on to weeklyoptionalert.com or call Brad at 866-661-5664. So that concludes my presentation, and I'm going to see if I can...
I'm sorry to interrupt you, Chuck. Can you hear me?
Yes, I can hear you.
Great. Thanks so much, Chuck. Really appreciate you coming on to do the webinar today. If you're all set, I'm going to go ahead and take the reins back from you.
Okay.
Just 1 second for me. So while we go ahead and get that set up, Chuck is great enough to come on and do these free educational webinars with us, usually on a monthly basis, and hopefully we can have Chuck out again next month. I know Tom and I would love that, if you can do that, Chuck. Sorry, we're just working on the screens right now, you guys. But for those of you who are wondering, and for those of you who had questions that we weren't able to get to today, we will have today's webinar put up on mytrademonster.com under the webinar archives for the month of November. That'll be up starting tomorrow, and you are able to download the webinar and watch it as many times as you want to. For those of you who have additional questions, please direct those to Chuck and his people. And the website should be coming up right now. If you see on the right-hand side of the screen, Webinar Archives, you click the down arrow, and you will see November 2014. Chuck's webinar from today will be up under that heading starting tomorrow. So you can also scroll through any of our past webinars, many of which are with Chuck. And definitely feel free to check out our free education page. It will have updates on our upcoming future webinars. And if anyone has questions about our free educational webinars, please feel free to shoot me an email at natalie.beckett@trademonster.com. I can answer those questions for you. So we really appreciate Chuck coming out today. Tom and I are very grateful, and we hope that you all enjoyed today's webinar, and happy trading, and until next time, thanks a lot.